Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the MarketSite studio in Times Square, New York City, we have Matt Kassel, Chief Operating Officer of Edgewater, to discuss what the biggest story in FX is for 2023 so far and where we can anticipate growth as we look out beyond that. Matt, it's great to have you with us. Welcome to Trade Talks.
Thank you for having me.
Tell us about Edgewater.
So Edgewater was founded in 2009, and Edgewater is a provider of end-to-end technology trading solutions. FX, precious metals, and soon to be fixed income. We have several different products and solutions that provide connectivity to the FX and precious metals global ecosystem. Access to over 200 liquidity providers in all the major data centers, aggregation tools, OMS, risk management tools, credit modules, just about every facet of a technology solution that a client would need to participate in those asset classes.
Interesting, 2009 to launch a platform like that. What has been the biggest story in FX in 2023 so far?
Well, the biggest story in 2023 has been a normalization of volatility. Starting from, call it 2008, 2009 financial crisis, interest rates had been normalized around the world to essentially zero. And stayed that way through various periods of jumps in volatility, whether it be the financial crisis itself, the Brexit move in Europe, Trump's election, the S&B fallout, COVID, the Ukraine invasion. There's always been these periods of events that created volatility, but interest rates were still globally at zero. Since the second half of 2022 and in the first half of 2023, you've seen interest rates rise globally at a different pace. And so those interest rate differentials are creating real volume and real FX hedging requirements that haven't been seen in the market in over 13 years. And that is a massive change in the market, and it's created an enormous amount of increased volume that clients are needing to be able to adjust to in this new interest rate differential world.
How does this tie into countries and regions that are experiencing significant inflation? Latin America is an example.
So inflation has obviously been on everybody's mind, and it's why the interest rates have been rising so much. There's been a dynamic that's taken place in the second half of 2022 where the U.S. exported inflation rather. And that happens because most of the world's commodities are based in dollars. And as the dollar was rising in a combination of rising U.S. interest rates as well as general inflation, the Ukraine incident and the invasion of Ukraine by Russia created a general dollar demand from a geopolitical environment, and all of that made all commodities, all products more expensive that they were priced in dollars. And this happened very quickly, starting in, call it May of 2022, March 2022, all the way through to now. And that exporting of inflation has been extremely disruptive, not only from a geopolitical perspective, but also from a financial modeling perspective for corporates, hedge funds, even countries themselves.
So let's talk about the geopolitical instability, whether it's Russia, Ukraine, tensions that we're having with China. How has that impacted your clients and your business in the past year?
Sure. I mean, we had a fairly large Russian business prior to the invasion of Ukraine. Obviously, the sanctions eliminated that entire facet. But the interesting part about let's call it just China overall and the geopolitical polarizing fractures that's taking place, not just here in the U.S. or with Edgewater's business, but from the clients that we speak to, they're just having a harder time navigating whether or not to be involved in emerging market debt, whether to be involved in a U.S. debt, which is another conversation. And there just seems to be a whole lot less certainty into what markets to get into as it relates to Russia, Eastern Europe, and China.
Yeah, it's interesting you bring that up because when we think of geopolitics, it's typically been ex-US, but now we're part of that story. So where do you see the biggest growth potential for FX?
So as I said earlier, one of the biggest potentials in FX that's going on right now as we talk is that the volumes are increasing significantly. Fixed income, which is a business that Edgewater is going to be getting into in Mexico with a partner, which will be news out shortly on that. Fixed income is the driver behind all foreign exchange movements. It has and always was prior to 2008-9 when there were interest rate differentials on a meaningful level, been the driver. And now that we're seeing that again, you're seeing volumes go from our clients that were trading, let's just call it, for example, 1 million in the past, are now trading 3x. And that increased volume is going to put stress onto the market if you don't have the right technology, if you don't have the right execution services business, and if you don't have the right follow the sun mentality of handling your technology and execution services. So the 24-hour nature of foreign exchange, which has always been the case with London in the center, really requires an extreme care of chosen technology to be able to scale people's businesses and to be able to maximize their franchises.
You mentioned Mexico. What's next for Edgewater?
So we're partnering with local entities all over the world, whether it be in India, Korea, and certainly in Mexico, which we've had a near 15-year experience with. And we will be entering into the fixed income market as partnering with a broker-dealer in Mexico, which will allow us to add fixed income to our foreign exchange and precious metals portfolio.
All right, Matt, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.